Hello and good evening, everyone. Welcome to our special webinar today. We titled it Follow the Smart Money. In today's webinar, we're going to show you how you could identify where institutional traders are putting their money to work, what it means for you and your strategy, and how you could apply it in your own trading. So that's the whole purpose of this presentation. We've got a lot of educational resources put together for you, and it's going to be a great piece. All right, just want to remind you first before we get started, the information in this presentation is for educational purposes. Does not constitute investment advice. The risk of trading securities markets can be substantial. You should carefully consider if engaging in such activities suitable to your own financial situation. TRADEPRO Academy is not responsible for any liabilities arising as a result of your market involvement or individual trade activities, and past performance is not indicative of future results. All right, that is a mandated disclaimer that has to be put on any securities trading and any kind of company dealing in securities. We're not dealing in securities, but trading them. And therefore, there it is. All right, guys, that's a friendly reminder. Let's get started. Before we get into the real heavy stuff here and get into the commitment to traders reports and how to read them, I want to play a little game. And I don't know if you guys are excited for it. I'm excited for it, and I hope you are as well. Let's start off with this. I love to do a little bit of an exercise. So if you guys want to follow along, it'd be very helpful. You'll get something out of this, I promise you. If you've played this game before, don't ruin it for everybody. Let everyone else have a chance too. All right, here's the game. Step number one, look around your room. All right, I don't know where you're standing. You may have an iPhone with you. You might have a mobile device, whatever you're doing. It's fine. Just look around your room or where you're currently sitting. All right, take in the environment that you're at. Now, take a second and notice everything that's green in the room. All right, are you guys doing that? Look around and see everything that's green. What do you see that's green, Paul? Gosh, this could get us in trouble, can't it, this little game? Anyone that wants to share what he sees something that's green? Paul, don't mess around. Trees, bushes, he's sitting outside. Phil, that's amazing. You're sitting outside. That's great. The top sheet on your bed, the broccoli that Henry's eating. All right, now close your eyes, guys. Just close your eyes for a second. All right. Are you good? Have you closed your eyes? If somebody types yes, either they're really good at typing with their eyes closed or they haven't closed their eyes. So good, no yeses. All right, what in your room is the color red? Detmar just hit a whole bunch of random keys on the keyboard. All right, Detmar, that's proof that your eyes are closed. What in your room is the color red? All right, are you guys having a hard time pinpointing anything? Did you notice anything red? I should have done blue because somebody already knew this exercise. But what's the color red? And you can open your eyes. Exercise is over. The whole point here is that when you're looking for something, it's very easy to find it. It's good, Phil. It's a good one. It's very easy to find it. You're looking for it. You'll find it. You'll memorize things. It's an easy exercise. But when you suddenly say what's red, it triggers your brain and says, oh, crap, this isn't what I was looking for. Suddenly there's information I don't have, and your brain panics, try to pull up this information and says, what is red? And it starts to freak out. And that's very similar to what happens in trading. And the reason that I did this exercise is the information you need to be successful is available to you. In this day and age, education and online trading has evolved so much. Everything you need to be successful is right there at your fingertips. It's never been easier to do this online trading thing. It never has. But at the same time, it's also never been harder. All right, you just have to train yourself to see the right information. When you're looking for things that are green, and suddenly you go to your computer to trade, and now you got to recall things that are red, it gets hard, it gets difficult. All right, your blood pressure goes up, you start to see sweat come out of your pores, you get nervous, your heart starts to pound fast, adrenaline raises, and before you know it, you feel like you're in battle. All right, because you're looking at the wrong stuff. And this is our specialty. TRADEPRO Academy trains you guys to see all the colors. So when you close your eyes and somebody does a silly exercise the next time, you'll see all the colors, you'll know everything, you'll be more aware. All right, that's what we do. All right, so in tonight's presentation, I'm going to show you one way to use the same tools as the professionals. What we're going to talk about today, commitment to traders reports, are used by any professional trader, and it's very gold information. It's invaluable information that's available for free. I say less than 1% of people use it that trade. All right, and in addition to that, I'll show you some other tools that you've likely never seen on your chart. You're going to say that and say, holy crap, what is that, George? I've never seen this thing. Well, you haven't seen it because it actually works. That's the whole idea. All right, so let me tell you a little bit about myself. I'm telling you, warning, a little bit of fun's ahead here. My name is George Papazov. I started trading a long time ago. I don't really actually remember doing anything in my life other than trading. And it's a little sad, but I do it very well. That's kind of what I do. Donald says his glass of wine is red. You guys are funny. So that's kind of what I've done. I've worked for one of the big 6 financial institutions here in Canada. I worked on trading desk. I traded. I also went into sales. I've taught financial advisors how to position trading to their clients. I've done a lot of stuff, but more importantly, I'm a guy that trades, and I still trade to this day. All right, and a lot of the questions, I know at the back of your mind when you hear these presentations, you wonder, well, why is this guy teaching something that he could do? If he had the secret sauce, why wouldn't he just be quiet and make millions? Well, you know, that's a one way to look at it when you don't have the ability to get that kind of money. When you start to make the money, you get successful, you start to realize, number one, it's a pretty lonely environment out there. Sitting in front of your computer and trading all day sounds amazing when you get rid of the boss, and when you actually start doing it, you start to realize very quickly it's a very me against myself type of environment, and you need to be social. I'm a social guy. Back in the workplace, I was a very social guy. So I said, you know what? Let's put an environment together. Let's build a community of trade pros. Let's start the education. I still trade every day myself. I rely on my trading for my income, right? My trading makes me the majority of my income. And the education, when I started Trade Pros in 2012, by the way, I'll give you guys the history. I was working for one of the big banks here in Canada. I was on the trading desk at the time. And in 2009, when the market crashed, I had clients calling on the phone. I've heard grown men 60-plus years old crying to me. All right, I've heard guys telling me that, you know, when I hang up the phone, I don't know if I'm safe or not, and I'm going to have to go, and I've had to call police on that. I've had to get compliance involved. I've heard the nitty-gritty. I've heard some really low moments. I was there in 2009. I saw accounts evaporate. And the thing that was really interesting at that time was I was the one that was squawking the alarm. I was saying, look out, it's going to go down. Nobody wants to listen to the guy that's got a contrarian opinion when everything's going up. Why? I'm going to miss the move to the upside. And suddenly, when 2008 and 2009 hit, when the financial bubble collapsed, I saw the fallout, and I said, you know what, enough's enough. I need to be the voice out there. I need to give the education to people, because it's completely possible, number one, to be your own money manager, especially in today's world. You don't need to hire somebody to take a percentage of your assets to tell you what to do with your own money. Nobody cares about your money more than you. All right, so what I want to do is empower the individual to become a self-dependent trader, self-sufficient, and to be successful at it. And that's where we started Trade Pro Academy. That's where we've been. I've done a whole bunch of stuff. I've traded for a long time. All right, I'm not here to sell you snake oil, Henry. You know that. Henry knows me well. Henry and I work together, actually, and now we don't anymore. And it's sad. It's a sad day in my life. There's a picture of me. I'm about 25 pounds heavier in this picture than I currently am. I've lost about 25 pounds. To master trading, you got to really master a lot of different aspects of your psychology as well. So that's me not too long ago, but gosh darn, there's about 25 pounds extra on that picture. And I'm glad I lost it. All right, let's talk about a few things. I want to tell you guys the psychology between a retail trader and a professional trader. You have to know, coming to this webinar, you're going to find out something about the institutional side of the business. And it's two very distinct psychologies that you have to understand. Here's a loop of what a retail trader thinks. He sees a rally in a stock, and he says, you know what, here's a dip. It's selling off. It's a little bit cheaper than it was a couple of days ago, but it's still too risky to buy. I'm looking for a little bit more confirmation. All right, I hope the police are not coming for me. I don't think I've done anything wrong today. Basically, the retail trader is saying, oh, well, what does the indicator say? What's RSI saying? They're looking for all this stuff that's super irrelevant. They say it's still too risky. It's not confirmed yet. All right, and they get this idea, you know what? It's going in the direction I wanted. I'll buy this stock on the dip. So what do? They get in there and they get long. They buy it on the second test. All right, great, nice trend line. RSI is moving, volume's increasing, sweet. All the technicals are on my side. And what happens, they say, woohoo, I'm a pro. I'm making money. I'm going to buy more. This move here that vindicates or authenticates the fact that they're right is actually the worst thing for their psychology, because they say, hey, I'm making money. I must be doing something good. All right, I'm going to buy more. The mentality turns from, okay, it's too risky to buy. Let me be patient. We turn from patience just to flat out greed. All right, and that's kind of where the retail trader thrives. Understand that luring retail traders to get excited is how the institutional trader gets out. All right, now let me show you the other side of this thing. This is from a professional money standpoint. Here's how this looks. All right, the trader here says, I'm already long. I've already used opportunities from the bottom to be long here. I'm long a couple thousand shares. I'm waiting for this dip. All right, what should I do? I'm going to buy more. Where it looks too risky to the retail trader, the institutional guy is adding into their position because they know if it's too risky here, that means the money that was used, that wasn't used rather, to buy on the retail side is waiting to buy higher. They know that fact. All right, institutional knows how to play with your emotions. You think it's a coincidence that when you're retail trading, you're saying, hey, I got in, it just hit my stop and it turned around. You think that's a coincidence? It's absolutely not. It's designed that way. All right, so the retail trader says, or the professional trader says, I'm going to buy more. I bought this dip. Then they see this, and what do they say? What do they say here? They say, it's starting to get risky. The same area where the retail guy says, it's no longer risky. I got all my technicals on board. And the retail is buying, the institutional trader comes in here and says, it's starting to get a little risky. The amateurs are on to us. They're getting excited too. Let's start selling these rallies. Because why? Where is retail going to buy from? Other retail traders? No, retail is always wrong and moves in the wrong direction to the trend. So the retail trader's got to buy it from somewhere. Have you ever thought about that? Where does retail buy it from? Well, look at this. Price pops back up. Institutions start selling to take some profit, and the retail buys it. And they say, woohoo, I'm profitable because I bought here. I'm right. Now I'm going to let my winner run, right? Isn't that what I'm looking for? And then what happened? Well, what actually happened is institutional traders offloaded their inventory on top of your head. They created a buyer. And this is why you have to know this. News cycles, you turn on CNBC, news cycles are always very optimistic right at the top of a market. Why? Because they do not work for you. These people that are in the news media know nothing about trading. Do you think any of them actually has a trading account? Let's be honest here. Let's get real. Doubt it. All right, the news cycle is there to support and to create buying. Okay, they're there to create buyers in the market, to get the retail excited, because their institutional friends here have a lot of inventory to sell. What do you do when you have inventory? Imagine having a whole bunch of eggs that expire next week. You have 3 million eggs. You're going to need to find some buyers to move them off the lot, right? Same deal with the market. That's why the news creates retail absorption of the institutional supply. Never forget that, guys. That should stick in your head forever. All right, now here's what happens. The retail trader says, I got my fresh long. I've gotten long here. Perfect. Breakout, volume's increasing, momentum's on my side. All technicals are telling you, all systems go. We're good to go. But it doesn't matter what momentum's telling you, what technicals are telling you. Institutional accounts are dumping that on top of your head, and you're soaking it up. And when you got a whole bunch of amateurs greased up to the same side of the trade, institutional money is already poured out and locked and taking profits, what starts to happen? Retail says, well, it was low risk here. I'm going to put my stop down here. All right, this is where my entry was. This is my initial entry. This is where I'm going to add. It's a dip. Let's buy the dip. Come on, people. Let's go. It's going to go up. And what ends up happening is it rallies up a little bit, gets retail excited. They're profitable temporarily. Institutional volume sells that rally and takes some profit. The next leg moves lower. Now these retail traders are saying, this is my entry. My gosh, it's getting close to my stop. It's very close. I think it's going to rebound. But now I've added once, twice. I have 3 times a bigger position. It's ready to go up. Now I'm going to move my stop here. But guess what? Institutions on this next pop, they sell to flatten their positions. They got nothing on the line at that point, and now you're sitting in there in the same boat with all the retail traders. You get your stops clobbered. Stops on the downside always get stopped and wiped out in one shot. That's the retail philosophy. Retail stops get hunted to the downside in one swift wave, and the fact that it moves downside quickly is telling you stops are getting hit. All right, this is kind of where our strength is at TRADEPRO Academy, finding those stops and making money as retail gets squeezed out. And institutional, what do? They start eyeing that long at that point, and then the cycle just repeats. This is the retail trader mentality versus institutional mentality. All right, and then you start to think, not again. I've been through this before. Geez, how many times is this going to happen to me? All right, how many times is this going to happen to me? Well, I'm going to show you how to follow the smart money. Doug says, love how honest and simple you explained this very real scenario. It's the truth, isn't it, Doug? I've been there. I know this feeling. This guy right here, I know this guy. I know this guy. Yeah, he's a little bit older than me, but I know him inside. I know how this guy feels. It really frickin' stinks, and I'm being truthful about this. It stinks to be on the side of getting fleeced over and over again, and you're sitting there wondering, how am I buying into things that always get stopped out? And I got to tell you, it's by design. Nothing's coincidence in this market. It's by design. All right, I want to get to know you guys. A few of you are starting to pour in here, and it's been all of us, Doug. Good for you for admitting and being straight up and honest. It's been all of us at some point. You have to be this guy before you're the guy that's successful. One of the biggest misconceptions in trading is that you could just pick it up part-time and make some extra money on the side. What makes you think you could go against professional traders and make some extra money on the side studying 1-2 weeks? What makes you think you can buy this indicator and it's going to make you all this money? All right, that goes against everything that we teach and believe in at TRADEPRO Academy. And I'm going to show you guys what we do believe in. But I want to ask you a few questions. Let me go to the polls. All right, this is a CNN breaking poll here. I'm going to run it for you guys. I'm going to launch it and give you a few seconds. Polls must be closed. Polls in progress. There you go. If you guys don't mind answering that for me, I'd just be very curious. I'll share the results with the group. Yeah, Henry, gold on Monday. That's how I felt too. All right. Gold had given us very distinct symbols that it was going to get clobbered. If you were part of our subscription base here at TRADEPRO Academy, we sent out that warning signal a long time ago that it was going to break. All right. We weren't long. Those 1240s looked like a good support. Below that 1240, retail stops galore. And you'll see what I teach you tonight actually showed the same thing 2 weeks ago. All right, I'm going to close the poll here. Nope, that's not what I meant to do. Sorry, guys. 1 second. Do you guys still see the poll? Close the poll for attendees. First, I got to pull up the slides again. I accidentally closed my slides. I just made a whole mess of my situation. This is what trading's all about. Sometimes you have a plan. You know what they say, Mike Tyson quote here, make a plan. We all have a plan until we get punched in the face. That's a quote. Love that quote. All right, let me just go present. Start here. All right, we're back. All right, so here's how it looks. Which markets have you traded in? 71% of you have traded stocks before, 47% currencies. We got a lot of currency traders here. 65% have traded options, 24% have traded futures. You want to hear something wild? You inverse that statistic, and that's the success rate of a trader. Most traders that are profitable are successful with futures, second the options, and currencies is the dead last, stocks is the third. All right, so it's funny that the ones that we trade most often are actually in reverse order to what most traders are successful with. It's interesting. We'll talk about a little bit about this. Thank you for sharing that with me. I have another question here to ask you guys. I'm going to click launch. Again, I'm going to just lay it out to you guys, and then we're going to get into the material here. How long have you been trading? Just curious to get a sense of how to really lay this out for you. Okay, 1/3 of you have been trading, actually almost half of you, 3+ years. 1/3 have been trading 1 to 3 years, and about 20% between. Okay, I'm going to shut it down in 3, 2, 1. Cool, thank you for sharing that. I'll show you guys the results. There they are. So you can see we have a pretty mature crowd here, so that's good. That helps me know how to present this information for you. One last question. All right, and I hope that everyone here answers this because it's going to be very useful in the way that we carry it forward. I want to share this info with you guys in the best way. I want you to take away the most content from today. I always focus on value. All right, here we go. In 3, I'm going to shut it down in 3, 2, 1. Last votes. Last votes for Donald Trump or Hillary in 3, 2. I'm just kidding. Close. All right, pretty good. 53% of you, more than half, you're day traders. About 1/3 are swing traders, and 1 out of 10 is an investor. So predominantly trading, our active group here that we got. With some of them swing trading, and I would imagine that a lot of you are kind of on the fence between day trader or swing trader. You're like, yeah, I probably do a little bit of both. And in fact, I'm all 3. You could be all 3, but which one do you identify with the most? So thank you for that information, guys. Really appreciate it. Let me go in here and share the screen once again. Phil says, I hope I passed. Phil, this, this is not a pass or fail thing. Oh, Phil, too much wine for you tonight, Phil. All right, guys. So let's talk about it. Let's jump into this stuff. How do you follow the smart money? There's two things to look for. So using order flow to find stop losses is pretty much as compact as you're going to get, as precise as you're going to get. When we were trading today, we found a nice stop run that went up 10 points right at the low off the exact low tick of the day. All right, when you start to use the right tools for order flow, which is what we teach in our day trader package, you start to get really granular, really micro. So for 53% of you out there, one way to follow the smart money is to follow order flow and find that precise moment where retail's about to get fleeced. Find out when everyone gets greedy, and then that's when you get opportunistic. And you can apply that on a day trading basis. When you day trade, there's no indicators necessary, none of the more larger term stuff that swing traders use. Now, if you're swing trading, that's also something that's profitable if you do it properly, just a totally different mindset and strategy. You could use the commitment of traders report as well. You could use it for both day trading and for swing trading. Now let me tell you what this commitment of traders report is. All right, basically based on the CFTC website, I'm going to read it verbatim, provides a breakdown of each Tuesday's open interest for markets in which 20 or more large traders hold positions equal to or above reporting levels established by the CFTC. If you're scratching your head and saying WT, you know what? I'm with you. That's probably the worst way to phrase that. Here's what it is. All right, it basically is data collected and published by the Commodities and Futures Trading Commission for free. This is a free report. I'm not trying to sell you the report here. I'm trying to show you how to use free information. That's valuable. That's worth money. This report should cost $400 a month. If they charge $400 a month for this report, I'd pay it. All right, it comes out every Friday at 3:30 p.m. Eastern. It's that important. All right, it shows changes to open positions. Imagine being a trader, a large institution. Remember, what you're purchasing is blocks. You're not, the retail trader gets long in a full shot and gets out in a full shot. So it's all or nothing, 1 or 0, binary type trading. Whereas the institution adds and averages in, and it's a smoother type of ride for their portfolio. They're in it longer. They're more invested. Imagine seeing data on equity indices, seeing what commodities these institutions are buying, seeing what currencies they're buying, and more. That's what this commitment of traders report does. All right, and it breaks down traders by whether they're commercial or non-commercial, and this is called aggregated data. We're going to go into commercial, non-commercial, and talk about which one is what and what to follow. This is some of the biggest mistakes traders make. They'll say, oh, it's all about non-commercial, ignore commercial. Well, no, that's not true. There's times where you need commercial. There's times you got to look at non-commercial. All right, and you might be wondering, well, look, George, if all these institutional traders are so secretive about what they're doing, why the heck would they show their positions? Why would they report what they're trading if they're trying to make money against you? Why would they tell you? And I know somebody out there is wondering that. And I'll tell you why. Just to confirm, you guys see the screen again, right? It's not the poll still? Just want to confirm that because... okay, good. If you're wondering why, it's because they gotta. Regulations stink. Regulations make it impossible for a regulated, licensed institutional trader to not report their positions. They fill out these forms, and then they have to self-report, and they're liable for it, and there's penalties if you don't. So it's a regulatory thing that's imposed on them. They don't want to tell you, but they have to. All right, so to get this report, you go to a website called cftc.ca, and I'll show you how to get there. It's actually .gov. It's not .ca. It's not a Canadian organization. Okay, so let me just pull up the window. I'm going to slide it over for another website. So I'm telling you, I'm getting hands-on right away here. I'm going to give you the full goods today. If you go under market data and analytics, you could go to commitment of traders, and these reports are published for free. The way they're published is it's published Friday at 3:30 p.m. Eastern time, but it's for positions as of the previous Tuesday. All right, so there's about a 9 to 10 day delay there on these positions, but they're very important and they can tell you so much information. It's actually not a big of a delay if you're a massive institution that has multi-billion-dollar long position. A week delay is nothing. All right, so you can go in here and look at these short formats and long formats. You could beat your head off of these numbers. This is how they report it. I feel like this CFTC organization hasn't moved outside of the 80s. All right, like there's no reason a report should look like this, yet it does. So what I'm going to show you guys is a better way where to get it. Forget about CFTC. You know where the data is published. This hurts my eyes. Even my head's going to explode just looking at it. So mark down this website, tradingstir.com. We are not affiliated in any way with this company. I don't support or endorse any of their paid products. I don't know what it's like at all. It's not kind of a referral I'm giving you. I'm just saying use their products. It's a phenomenal service for caught charts. I'm eternally grateful for whoever runs this website for doing what they do. All right, but go to tradingstir.com. Go in here and look at stock indices, and you could right away see, you could look at live cattle, lean hogs, metals, softs, cocoa, energies here. You can see treasuries, fixed income bonds, all the currency products. There's a report for it. Let's get in here and learn how to read these, and then I'm going to take you through a live analysis. By the end of this webinar, I'm going to take you through a live analysis of today's markets, today's commitment to trader reports, and what it could mean for the future. So we're going to build a live forecast. All right, that's where I'm going to get you guys to. Before we get there, I need to share with you how to read them. All right, so using tradingstir.com, you start to see a little bit more of a clean chart. Now, let me go back here and actually open one for you. Let's assume that we want to trade or look at positions on institutional books on a stock index, the E-mini S&P 500 stock index. So if we go under COT, we click this button and we pull up this chart. It shows you all this data. It shows you long versus short positions, net positions from a historical perspective of time. You could stretch this thing out and go far back and look at the price versus positions. You could do a lot. Let's start with the basics before we get into all this stuff. All right, let me show you how to read this report. How many of you actually use the Commitment to Trader report or have heard of it before? Can you say yes? So I get an idea here of how quickly to dive into the more advanced stuff. Yes, yes. All right, good. Obviously, our subscribers at TradePro have heard of it. We use this on a very frequent basis. Every Sunday in our webinars at 8 p.m., we spend a large majority of time analyzing this data because you can see how powerful it is. All right, Matt has heard of it. Hi, Matt. Welcome to TradePro Academy, by the way. I haven't had a chance to reach out to you yet. I've been meaning to. Welcome. Matt is one of our new Trade Pros. Howdy. All right, here's the first thing you're going to notice. So we go into one asset and there's just this blot of data. It just gets plopped on the screen. The first thing you got to look at is understand who these players are. All right, so let's go down and break it by one and talk about who are the players, who are being reported here, and whose positions are being reported. Dealer and intermediary, these are large banks and dealers in securities. All right, so basically they have clients here, and the clients say, I want to buy a product. Sorry, my writing needs to be cleaner. I have a pen for this specific reason. I want to buy to speculate on an increase of gold, let's say, and that's Henry, because he loves gold. I love gold, the gold member. All right, and Henry will say, I want to buy a contract off the market because I'm a large trader, massive. I need to buy a contract to speculate long gold. You're going to have a bank that comes in here and says, I'll sell it to you. All right, so the buyers here, the institutional volume is called the buy side of the market, and the banks or the dealers and intermediaries are called the sell side of the market. What you need to know is that on the sell side of a market, these guys are not in it to speculate, because when they sell you that gold contract, all right, what they go in and do is actually buy to offset that position. They neutralize their risk to zero, and they make money on their spreads. They basically make money on commissions, fees, spreads. They're not in it to speculate for the market. Therefore, dealer or intermediary category is what we refer to as the sell side of a market. And we basically ignore them for the most part. And I'll tell you when there's big indications that come out from these guys, very rarely, but when they comes out, my gosh, you better listen. All right, for the large part, we put them on the back burner. I'll come back and we'll revisit that after we know how the report works. The second category is asset managers or institutional. This is our bread and butter here. This is super duper important. This is the whole webinar basically. All right, and these are your pension funds, endowments, insurance companies, mutual funds. This is the smart money. This is the institutional money that gets long and trades to the upside and stays long. And yes, retail trader looks to get long here and sell to get out and repeat this active trading strategy. But these guys just get in and ride it out. Okay, they're your longer term, longer horizon institutional money, and you're going to see they're large, they're big. They're huge in size. Tons of money is on that side of the book. This is called the buy side of the market. All right. Leverage funds are also the buy side, but they're hedge funds. CTAs, commodity trading advisors, is what CTA means. And they're taking outright market positions. This is flat out speculation. They think it's going to go up. They think it's going to go down. All right. This is speculative money. This is risk. It's hedge funds. It's called the buy side of the market. It's more aggressive, faster turnover of the portfolio book, and less driven to make gains on the upside. All right, when you start to go to the downside, hedge funds have the ability to make money. Asset managers, institutional side, don't participate on sell-offs, they hedge, which is kind of misleading because then they fall in the hedge category as well. But don't confuse a hedge fund to an asset manager hedging to protect the downside. Totally different things. All right, those are the three key categories you need to kind of go through. All right. Now, we can kind of read the report a little bit better. Let's go in here and read the Commitment of Traders report. Why is it called Commitment of Traders, ask somebody? Because traders are committed, and they're committed people. And they're committed to these positions, and these positions are reported. So Commitment of Traders report. I don't know, CFTC chooses. The CFTC is not a creative organization. You saw the reports. Do I really have to say much more than that? So we pull up a chart of the Commitment of Traders report here for the S&P 500, and let's go in here and look at what we could kind of come up with here. Understand dealer and intermediate. Let's start with asset manager, institutional money. Okay, we look at this report horizontally. This first column is long positions. The second column is short positions. The third column is spreads. We're not going to talk about that tonight. It's helpful sometimes. When it's really helpful, I'll tell our subscribers about it and what it means. Right now, I just exclude it for a minute. All right, so when you look at asset managers, you can see they have $1.4 million long. Wait a minute, that's nothing. That's not dollars, that's contracts. That's futures contracts. The current futures contract on the S&P 500, what is the price it's trading at? Let's say 24.30. All right, so 24.30 is the current market value times $50 a point. All right, it's $121,000. Point times the $1.4 million contracts. You're going to see every time it moves, that's what you're looking at as a dollar value. All right, essentially, the exposure for this contract is insane. I got to recalculate that for you. I did it totally wrong. Somebody should call me out on that. Don't let me get away with crap like that. All right, the E-mini futures are 50 times. All right, 50 times the price of the index. So it's 121,000 notional value per contract. And you multiply that by 1,439,924 contracts. You're getting at 174, all right, $1 billion notional value. Let that sink in for a minute. $174 billion long in the S&P 500. So you're seeing massive money at play here. This isn't a joke. This isn't one or two contracts that we buy. This is big assets. What you're going to notice is the asset manager side is long 1.4 million contracts, and they're short at the same time 775. Well, why the heck would they do that? We just said they're long. Well, they're long, but they're also buying downside protection. So a company or an investor that's perpetually long, if they see signs that point to the downside, what are they going to do? They're not going to sit there and lose money. They're going to take measure and take a short position to offset the losses by the gains made in the short. Therefore, it's like they don't lose. They basically go neutral on their book. And what you're seeing here is 1.4 million to about 700,000 to the short. That's what you expect out of an institutional account. You expect them to be about 2 to 1 on their long to short coverage ratios. 2 to 1 is good. If you start to see 3 to 1, all right, 3.5 to 1, that becomes an extreme. It comes to the point that they've built such a long and aggressive position is that, you know, at some point they're going to have to puke. They're going to have to sell off and either increase their shorts or bail out of their long and take profit. So 2 to 1 is normal. It's where you expect it to be. It's a little bit bullish, but in an uptrend, that's where you kind of want it to be at. All right, so now you're seeing it's a relationship of long to short, but more importantly, it's also what are the changes. So on this past Friday, this report is for the last Tuesday before the past Friday. This Friday will come out for a report for last Tuesday. Okay, so this report indicated that 44,000 contracts were taken off the long side. How do you know whether somebody is selling to close a long or selling to open a short? Well, the CFTC tells you. Minus 44,000 contracts are subtracted from the long side of the book. All right, 20,000 contracts were added to the short side of the book. In one sentence, one of you, what is institutional money doing the past week and a half? What has it done? Tell me in a sentence, in a human language sentence. Considering they've removed 44,000 contracts and added 20. What are they doing? In a human language, easy to kind of break down statement. Cashing up, bearish. They're taking profit, right? They've been long. They sold out a little bit. They sold some of the long side exposure and they're hedging some of the downside books. So they've simultaneously reduced exposure to the long side and increased the hedge to the downside. What you're seeing is bang on the table, money off the table scenario. Exactly. Money is coming off the table. Okay? Now, what are hedge funds doing? Hedge funds can't get a darn thing right this year. Hedge funds are struggling. They're doing terrible. You need to know that. Hedge funds have maintained a net short position over the last 2.5 years, preying on this crash. And I'm going to tell you something. They're eventually going to be right. And when you start to see hedge funds that can't get it right getting long, you could see who bought the inventory that was sold by the asset manager side. Hedge funds got long. They cut their shorts and they're getting long. When you start to see a hedge fund industry that's always been saying the market's going to drop 20, 30%, when you start to see them buying in large quantity, these are your perpetual shorts. They're always shorting the market. When the short sellers buy, what happens? What happens when a short seller starts to buy? Think about this psychologically because it's counterintuitive a little bit. What do you think happens to the market when the short sellers have bought into the marketplace? Think it's going to go up or down? It's going down. It's going down. Why? Because you guys have to understand the dynamic. Why does the market go up? It goes up for two reasons. One is new buyers, but who the heck is buying at all-time highs? Not the institutional side. Maybe some retail traders that get excited, but it's hard to get excited with North Korea firing ICBMs that could now hit Alaska. It's hard to get excited about any of this. So there's fear in the market. So who's buying? Nobody. So these recent run-ups have been shorting the market and then chasing the price higher to get out of their short, to get squeezed out. That's what's driven the price higher. Now that you're seeing these hedge funds go on the long side, everybody's long. There's no more short sellers to squeeze, which means the only natural course, the path of least resistance is to the downside. So look out below on the Commitment of Traders report. Look out below on the S&P 500. All right, asset managers are pulling money from the long side. Hedge funds are piling into the long side. That is a clear-cut signal that the next 50 handles on the S&P are probably going to be down. All right, any questions on that? I kind of just went from 0 to 100, didn't I? I picked up the pace. All right, let's look at something else now. Let's say, well, from S&P 500, our conclusion was money's coming off the table. You guys said it, not me. Let's look at another Commitment of Traders report for the Nasdaq 100 index. Phil says, wow, this finally makes sense to me. Phil, get off the lawn and get over here and let's have a beer together. That's the best news I've heard all freaking day. I'm happy. Happy to hear that. All right, now let's look at Nasdaq. Nasdaq on the way up on this market rally has led the way. If you don't know that, you're looking at the wrong things. You have to know the tech sector has led the gains for the last 5-6 years. Tech is where it's been at. If you remove technology sector, you're going to strip away most of the gains from the S&P 500. And when you look at where hedge funds and a lot of the institutional money is, a lot of the top 10 holdings of these institutional funds are among 5 to 6 companies. So we're very leveraged. We're very compressed into a few names of companies. So when this thing goes kaput, it's going to come down hard. I can't tell you when it's going to happen, but my gosh, when it goes down, it's going down hard, free fall. Because every trader knows this. It's easy to accumulate a long position. A massive long position is very easy to accumulate. There's always somebody willing to sell you something at the right price. It's always difficult to find a buyer. Selling a large position, you could start here and accumulate it and have billions of dollars of profit as a fund, and by the time you're able to get out of it, you have a loss and you have to shut down your fund. That's why you think it's fun to be a manager. You think all these profits on the upside, but you haven't made profit until you freaking sell it. Understand that. There's no profit until there's a sell transaction to put the money, the position into cash. All right, let's look at Nasdaq. Nasdaq's led the way up. What's happening in Nasdaq here? Asset managers, again, are pulling from the long side. They've reduced their exposure, 8,000 contracts. All right, and asset managers are net long. It looks to be about 1.5 to 1. 82,000 positions long, 35,000 positions short. So they're about 1.5 to 1 on the long side skew here. But what the professional money has done is they've taken money off the long and increased their short. Where have we seen this before, other than the Nasdaq? Where did we just see this? The E-minis, the S&P 500s. Henry, we're going to get into that. It's called swap dealer or managed money. On commodities, it's a little bit different. The S&P said the same thing, net outflows. What are the hedge funds doing? They got long Nasdaq and they got short to a larger extent. So they've maintained about a 3 to 1 short to long ratio over the past week, and they're increasing their short side. However, they're net long as well. And you're seeing an interesting thing happen here. Hedge funds are long tech and short overall broad market indices, while the institutional managers are long everywhere. So now, guys, what does this mean? Where's money? Is it coming into the Nasdaq or out on a weekly basis? In or out? Outflow or inflow of money? Outflow, bingo. All right, let's continue. Let's go to 10-year notes. Let's have a look at the bonds. The bonds are super important. Now look at this. Asset managers on the bond side have cut 20,000 from the long. They've gotten out of the long side and increased their short to roughly the same extent. They're still long on a net basis, but very thinly so. You could see just almost 1.1 to 1, 1.2. It's kind of ballpark. I'd have to run the math for you, but and you got to just ballpark this stuff. It's not an exact science. It's an art with scientific approach to it. All right, so we cut the long side and they plowed it into the short side. So they're getting out of bonds. Why are institutional traders getting out of bonds? Because they're scared as heck from Janet Yellen. This Fed is beating on a hawkish drum. They keep thinking rates are going to go up. They're going to unwind their balance sheet. Who are you going to sell these bonds to off your book? You going to let them roll off? All right, great. Interest rates are going up. You're going to kill liquidity. Are you going to pull in the Federal Reserve Bank liquidity requirements? If not, and if you keep liquidity high, you know you're paying interest on that, so now you got a debt liability set up for the future. So the Fed, they shot themselves in the foot. They're trapped and they know it. Nobody wants to own bonds right now, so they're getting out of the long side. Look at this. Asset managers shaved 20,000. All right. Hedge funds took 32,000 off the long side and 107,000 off the short side. What do they do here? This box right here, does this mean that hedge funds took profit? All right, or that they got out of their short at a loss? Yeah, North Korea is a big part too. There's a lot of fear. North Korea should technically drive asset flow into bonds. All right, this is how crazy algorithms are. Algorithms are pumping up the Japanese yen. Japan is literally within spitting range. Kim Jong-un could throw a missile to Japan by himself. He doesn't need a launch pad. And the yen is going up in value. This is how crazy markets are sometimes, but that's okay. They could be crazy. That's what creates opportunity. All right, somebody said it. That's right. They're reducing. They're taking profit on their short side. So let me ask you this. Bonds, there's outflow or inflow of money. Out or in, based on this report. Out. There you go. You guys are punching here with the trend. Yeah, it's out. So you got an outflow. So wait a minute though. This is why the commitment to traders, I tried to write an article on this and I got arthritis and I barely explained 1/10 of what I wanted to say. It was a really long article. So I said, you know what, webinar time. Isn't this interesting? What happens when bonds go down in price? What theoretically should happen according to asset allocation models and modern portfolio management theories? What should happen here? Bonds are going out, equity should go up, right? All right, great. But what do we just see on the commitment to trader report? S&P 500, negative net outflow. NASI, negative net outflow. 10-year notes, negative outflow. All right, cash is coming out of this market at a strong pace, and these retail crowd guys are just loving this. They're buying it. Let's go higher. All right, great. We need buyers so the institution could dump their portfolio on top of your head, but understand money's coming out here, and it's not a slow pace. This is large dollars that are coming off. 32,000 contracts on 10-year notes. You know what a notional value that is? It's massive. It's huge. So money's coming off the table. All right, well, George, bonds are down and equities are down. Cash is coming out. Maybe it's going in gold. All right, maybe it's going in gold. Well, like in gold. In gold, by the way, and Henry mentioned this, in gold, it's not the same way. If we look at asset managers and leverage funds, so hedge funds and institutional, they're actually summed up in one category called M&Ms. I love M&Ms, peanut butter M&Ms, yum. Can't eat them anymore. Actually, I don't really like them that much, but I used to love them. M&Ms basically manage money, and that's the two additions. So when you look at commodities, the CFTC does not disaggregate information. It's called aggregated positions. They're added up. Manage money basically tells you they puked. They got rid of 20,000 contracts. 20,000 contracts on gold is a massive position. Just look at it. All right, that's approximately 15% of the entire long position got plowed out of that. Where did that go? Cash. And they increased their short side, and they're still 2-to-1 long of gold. So wait a minute. Now you're telling me money's coming out of gold too? Where is this money going? Who wants to answer? Now you've got this massive perspective on the market, and you know where the professional money is going. All right, it's going into cash. So what does this mean? If you kind of put a conclusion for what we've done so far, these are the most recent commitment to trader reports as well. The conclusion will say the following: the money's running away. Okay, the money's simply running away from the long side. They're cashing out. They've seen enough. They know summer seasonality, the market goes sideways. Again, you're listening to a guy that's been trading for 14 years plus. I've been through a year or two of a cycle. I'm not a guy that says, oh, look, my strategy works here, and then I lose all my profits here. All right, it's a long-term game. And institutional money knows the same. They know we're going into a period here of some sideways price action for the summer doldrums. They know how August ends towards the lows. They know what happens September. Most crashes historically have happened in September, and VIX has popped up. Volatility has increased. They know that's coming. They know the pressure to the downside is there. This is not a real chart because you could never go back in time. I was watching a global warming documentary, how it's a hoax. They said, here's the periodic increases of gas over the X amount of time, and it actually did this. I kid you not, guys. Something like that. When you start going back in time, be scared. FNN, yeah, maybe. Smart money's running away from the long side. You need to know that. They're taking profit. All right, and what's happening with the cash? Well, here's the thing. It's either ready to buy the next dip that comes down in the marketplace. Watch for support. Watch where those levels are. Watch for reactions. As a swing trader, you got your answer. You know there's dollars on the sidelines. What does dollars mean? Dollars mean BP, buying power. So now you look at the sell-off and the next sell-off that comes. Look at a support level and say, is there volume coming out at these supports? Because if there's volume coming out, we know it's institutional money. We know there's cash on the sideline. We know they're buying it. If these guys are long up to their ears, 5-to-1 ratios, all right, and they have nothing on the short side and the price starts dropping, don't be buying that dip. Oh boy, that sell stop's waiting to happen. There's no cash waiting to absorb that sell-off. All right, so now you've kind of got a perspective. Next couple weeks, this is what I told the guys on Sunday. Watch out. The professional money's running from the long side. They're starting to hedge to the downside. They're getting worried. Retail is flush long with market euphoria and optimism. Nobody thinks the market could go down anymore. There's people who are now trading, who have been trading for a few months, that are emailing me saying, well, why don't I just buy that? Well, because you don't remember long enough. You don't know what you don't know, what's possible. All right, people forget that markets could do this. And guess when that happens? When the most amount of people forget. When the most amount of traders are trading that forget this happens, that's when it's going to happen. Don't forget, the Nasdaq crashed 87% this weekend. Amazon was down 87%. It was a glitch. It's a glitch, but it's a reminder that's possible. All right? Now you build a consensus. Money's coming out. If, on the other hand, let me give you another piece of analysis that could have differentiated this conclusion. If you would have said, hey, you know what, money's coming out of equities, but it's going into bonds, all right, and it's going into gold, I could say with a little bit more clout that that's more bearish, right? Because the money is allocating. That's a traditional asset allocation between fixed income and equity. Money's flowing into fixed income. that's looking for some safety. It's looking for refuge. It's a safe haven asset. Gold's going up as well. That's good. That's what you expect. I'd say this is looking a little bit more bearish. But the fact that it's in cash tells me this next dip could get bought up as well. And that's how you kind of put together all these factors into one to come up with a sentiment or statement about this. All right, Henry says gold is still long 2-to-1. They are, correct, but they're starting to puke too. They're starting to come out of there. Remember what we said. It takes a little effort to build a long position and a lot of effort to get rid of it. All right, I'll tell you one thing. I've never seen offers evaporate. You guys know what I mean by that? When you look at a price ladder, you see bids and asks up the ladder. Okay, bidding prices, asking prices. As prices increase, you're going to have sellers that get interested because they're going to make more money to sell at a higher price. I have, however, seen bids virtually evaporate. I'll tell you what I mean. Market starts crashing 10, 15, 20 points in 2 seconds. Who wants to buy that? Who wants to throw in a bid and say, I'm going to get long? Who? Nobody. All right, so nobody wants to buy it. Guess what? Market drops because there's no one willing to buy it. Sellers get desperate. They're looking for buyers. There's no buyers to find. Buy-side liquidity just absolutely freaking evaporates. I've seen it. August 2016, I've seen an evaporation like that of liquidity, and my gosh, can those prices come down fast on very low volume because there's just no buyers. Everyone just ran away. Everybody's a seller at the same time. Nobody's willing to buy it. They're going to have to get a lower price for their sale. Simple. All right, the Commitment of Traders report will tell you that. If we're getting down to it, guys, and I know on this webinar, I don't want to sound too negative. All right, I'm an optimist. Okay, I believe in Buddhism culture. I believe in positivity. I believe in awareness. I believe in society and people and humanity and compassion. But my gosh, this market looks ripe for some downside. I'm telling you that. Smart money's positioning that way as well. So I'm very interested to see what the Commitment of Trader report looks like this Friday. See what they've done with this downside. All right, how do you apply this COT to your trading strategy? I think I told you, day traders, 53% of you out here. You got to know where the smart money is trending towards. You got to know where the momentum is moving towards. I don't care that you're only in for 12 seconds if you're a scalper. If the trend is going up in 12 seconds, you're more likely, probability-wise, to move in the direction of trend than you are to reverse it. I know it feels great when you see something going up and you hit the bid and you smack this thing and it drops 5 points and you make money and you say, haha, I made money while others lost. I know it feels great. But don't get too happy with that feeling because you just took the hard trade. Just as easy as you're laughing at the people that lost, they can just come up here and bully you up 10, 15 points, force you to cover your short up there and drop you right back down and say, haha, look what you did. Right? So even as a day trader, you got to know where the smart money is playing towards. Go to the path of least resistance. You know there's cash on the sideline. You know there's a support level. You look at your volume profiles next. You look at your analysis. You look at our overnight high-low close TRADEPRO indicator that we have coded and available to subscribers. You look at all your supports, resistances, and you say, I know there's cash. If it bounces off this support and I see volume increase and it can't break a low that it's had in a range, get long. Why do you think we're long this morning? TRADEPRO subscribers, you guys remember we got long literally one tick off the freaking low for a 10-point rip. All right, I traded Nasdaq, but we got the ES pretty much. We caught it right in that reversal moment because we know where the smart money is going towards. It's getting long, and it's using rallies to sell. Volume is coming in at the bottom, and volume is coming in at the tops. And this is a transitional moment. I don't think we're at the point where long side's worried, but I can tell you this North Korea crisis, if it starts to get a little bit more sticky, look out below. There's a lot of money waiting to dump. And guess what? We're getting less and less retail traders that want to buy. They're already long. That's going to be a disaster, and it's coming. I don't know when, and I'm not going to be the guy that says, ha, I knew it was going to come. I'm going to be the guy that says, man, I really feel sorry for these hardworking people that are just getting punched in the face. They work 9 to 5, 9 to 9, whatever it is, come home, look at their portfolio, and I just took a shot at them. They should be managing their own money. They work so hard for it. Nobody cares about your money more than you. Right? That's day traders. Don't fade that kind of move. I mean, if you get some good indicators, look for qualifiers. This is why I say don't fade it, trade it. Look for low-risk entries that match your qualifiers. The COT alone is not enough to help you trade, but the COT, in addition to what your qualifiers are, what your strategy is, your money management, will help you find that moment where the market takes off. If you're getting long as a day trader and you're waiting 30, 40 minutes for the thing to move, you're just bad timing. I get into a trade, if it doesn't go within my direction in 3 minutes, I get worried because I'm not catching the wind. I have my sail open, the wind isn't blowing. What does that mean? I'm not going to move forward. Whoops, maybe I misread direction of the wind. Get out. All right, that's what we teach at TRADEPRO Academy, the precision to get in right moments before the thing moves a couple points. Even after a day of sideways chop, we'll always find that one move with 1 to 2 tick precision. It's crazy. You think I'm nuts? That's fine. Maybe I am. All right, swing traders, know the smart money and ride the trend. For you, you should definitely not fade it. Look for opportunities to end the trend with the big money. As of last week, there's a big cash float sitting on the sidelines. What do? You wait for a dip, wait for it to react off of support, and you get long because that's what everyone else is going to be doing with the big accounts. All right? Stop looking at a downswing and saying, I'm going to short it just so I can be right. If you're trading to be right, find another job. I'm going to lay it out with you, just honesty. I'm always an honest person. If you're looking to be right, find another job. Trading ain't the world for you. If you're looking to make some money and build an opinion and execute the opinion, but when your opinion's wrong, change it. If you have some discipline, we can work with that. We can make great things happen. But if you're looking to be right, trading's not the place for you to do that. All right, here's a TradePro Edge. Let's talk about this. Paul said 19.5 bottom last night. Paul, didn't you get a long there today in the room? I think Paul got him long. Either you or Nick, one of you guys just literally destroyed it today. I'm sitting there looking at you guys like, man, you guys doing better than me. TradePro Edge. Let's talk about the TradePro Edge. Every week on Sundays, we analyze this data for you. I understand it's a lot of information right now for you to process. You don't have to process this yourself. I look through all these commitment of traders reports every day. It's Sunday at 8 p.m. We do a market analysis live webinar. Sit there, talk about the markets. Where's the smart money going? How should we position it for ourselves? And where's the levels that we need to act? All right, and what are the stocks that are going to benefit? That's the 3 things we talk about. All right, if you miss it, we archive it. You can watch it as a replay. Talk about money flow, momentum, and trade execution. That's part of every package that we offer. Let me tell you a little bit more, because the way you guys answered the questionnaire, there's 2 types of you out there. All right, there's the day traders and the swing traders. You got to decide which one you are, and you have to have 2 strategies for each. All right. Once you decide that, we got the edge. Here, the TradePro Edge is the following. So when you're swing trading, the strategy that we focus on is options. It's more of a passive strategy. If you got a 9-to-5 job, this thing runs on the side with little maintenance, but you're going to have to compensate for that by having maybe wider stops, having less capital invested, and being more disciplined. That's how you compensate for that. Okay, there's nothing perfect. There's compensations you're going to have to make. All right, you get a weekly newsletter every Sunday with trade ideas. We give you a strategy selection tool to help you select the strategy that's right on your bias. And the weekly live webinar at 8 p.m. every Sunday, talk about commitment to traders. And every single day we send out this daily unusual activity report. And what this tells you is, here are 3 options or 3 stocks, sometimes 3, sometimes 2, sometimes 1, depending on what's out there, that have a lot of option volume on them today. Here's what these options are. Here's who traded them. Are they institutional or retail? We think this has a high likelihood of an upside move. And I mean, these aren't stocks that I just sort of go out there and say, hey, look, you know what? They might be nice for you to buy. I buy them myself. Look, I'm long CYS right now, 800 shares. It's not a demo account. It's a live account. Let me just block this out. You don't need to see my account number. Read only means I can't put positions because IB gives you this annoying card you got to key in every time. Anywho, for those of you at IB, you know what I'm talking about. CYS, I'm long 800 shares, NOG 500, VER. These are all our option scanner trades. All right, and that's kind of what you get on a daily basis. I'm in it with you. Like I said, first thing I told you is I trade. I just sit here and do webinars. I trade as well. All right, and you get our weekly stock watch list and options. If you go to TradePro Academy, I'll show you what that looks like. Yeah, Doug, I have. He said, have I analyzed the success rate of this strategy? The bottom line of this daily strategy, the emails that we send, is risk management. Okay, with proper risk management, it's going to win. With looser risk management, you're going to have a little bit of trouble because you're buying the stock. Sometimes you're buying the options. There's time value. and picking good locations. Just because you like a stock, great. Now when do you actually execute? When do you buy it? And that's where it starts to get a little tricky. You know what? I'm not going to show you the watch list. We do have a watch list. We maintain it every day. Just a little bit slow to load. All right, for day traders, that's kind of what we offer for swing traders. Swing trading package, it comes with full education and full option stuff, and a lot of value there. Okay, education, we have a full foundations course. It's got a workbook, number of lessons, 24 lessons to be exact, workbook. There are videos, quizzes, a whole bunch of stuff. We got you guys covered. All right, for the day trading side, we trade every morning at 9 a.m. to 11 in a group. I show you guys all my trades, do the analysis. When I buy, you see it on my screen. I know I'm not one of these guys, oh, I bought. What? Never mind, I didn't. If I click it, you see the blue arrow show up, I'm long. And if I lose, I tell you guys, whoops, stupid trade, I shouldn't have done that one. Or whoops, that's a clean loss. All right, we have a community trading room that you guys can be part of. And at the end of the day, the real grab here is the prop firm level trading. You're going to get training the proprietary traders get when they join Goldman Sachs. I can tell you that because I use the same software and I know what those guys are trained on, and I could show you pages from their training manual if you like. I actually do have screenshots of it compared to what I show you. I go more in depth with the material here. All right, so you're getting a prop firm level training and you're going to learn things you never thought you would ever hear of. The two packages work like this. I'll show you a little bit more for the day trading side in just a minute. I'll show you everything that we offer, the value, and some feedback from our current clients as well. So it's $79 US on a monthly basis for the options package. All right, 99 bucks for the day trading package. They're two separate ones. You're going to get both, $139 a month. That's 20% off. It's a monthly package. There's no commitment. You don't have to sign a 30-year deal. You're not buying a property. You're buying some trading stuff. All right, I'll throw in a midnight bonus. No problem, Doug. I'll throw in a midnight bonus for you guys. If you sign up before 12 a.m. EST today, I'm going to give you guys a free group coaching session with me, either one of the packages. And what I'm going to help you do there is answer all your questions and get you started. Craft your trading plan for success. Take the next steps. Ask you some questions, what courses you should take, how you should learn, what trading plan might be best for you, what approach, what product, what tool, that kind of stuff. Some real tangible things, quality. All right. Does it work? It's not theory we're teaching. We're showing you how we teach on a regular, or how we trade on a regular basis. And I'm going to tell you this, sometimes when you get into trading, you say, geez, you hear all this material. Do actual profitable traders exist? Well, they're not unicorns. They're at TRADEPRO Academy. All right, that's where it's at. Let me show you guys a few things. A few emails I've gotten. I always kind of keep these fresh. Some people I've blocked out their name because I don't want to show their name, obviously, and neither do they. All right, short note, from August to January 17, I was paying a monthly subscription to a stock and options trading company. After losing 60% of my trading account, I packed it in, kind of in shock, but learned some valuable lessons. Lesson 1, find an educational trading program that works. I took a bit of time to digest what just happened, regrouped, and started looking. I'm so fortunate to eventually find TRADEPRO Academy. You teach your students the tools to be successful. Awesome. I love to hear that. I just finished the first lesson on order flow, and I got to tell you, a big aha moment. Thank you so much for all you do. I can envision myself finally seeing the light. Things you mentioned, your updates are routine for you, but for me, they're an eye-opener. So stoked. Thank you so much. I guess you're not surprised with all the BS trading education out there. It's taken me 4 years to get to this moment, find a reputable educator. The fact that we actually get to chat for minutes blows me away. I guess he was surprised that he could talk to me. I find that surprising because it's, man, we're people at the end of the day. What am I going to do, hide behind the computer? I'm in there. I'm in the trenches with you guys every day. So he basically says, thanks for your transparency, willingness, the way real education should be. All right, Cameron. Cameron actually let us share this piece of info. He said, blessing to finally come across a course that's actually teaching me fundamentals of trading. You're a phenomenal teacher. I'm excited about TRADEPRO Academy. Thankful and humbled to finally have an experienced, straightforward mentor teacher. Looking forward to graduation. We'll throw the hats together, Cameron. And God bless our TRADEPRO Academy. That's deep. Thanks, Cameron. I get these things regularly, and at the end of the day, guys, I'm not promising you're going to make millions of dollars. I am promising you if you're going to be successful in trading, you're going to have the best shot through what we do. I could stand behind that. All right, we put together the tools, and I unfortunately get some people who have tried elsewhere and come to me and are very skeptical, and they see the light. All right, and other people who just get to find it the first time around, which is good. All right, here's one last example. one of our students asked me for a little bit of advice, and kind of like the other guy said, hey, I'm surprised you're accessible. I went in there and broke it down for him. Here's my observation of your results. Here's what the big losses are due to. Here's a few suggestions to try to change around your trading. Here's a strategy that I showed him that I use for risk to reward management. Look, you win 40% of your trades, you should break even. If you're not breaking even with a 50% win ratio, we've got to clean up the money management. That's your next goal. And that's all that this says. And guess what? That's what that person needed to hear. I wasn't being rude. I'm being straight up, and I want to help you guys. I'm here for you at the end of the day, and so are me and Donna. All right, nothing comes from doing nothing. Take action. These are the 3 packages. The day trader one's $99, Options Pro $179. The total combines $139 a month. I can tell you this, satisfaction guarantee 100%. If you're not completely satisfied with the first month with your subscription for any reason, contact us. We'll give you your first month's fees right back, 100% of it. I don't even want to ask you any questions. I might ask you, hey, what can we do better to improve our product? But I ain't gonna give you these questionnaires. You don't have to submit me trades or logs or any of that crap. That's a waste of both of our time. You don't like it? You know what? Have a good time. We're always here for you. Here to help you at the end of the day. All right? And I think if you're buying a product that doesn't have a satisfaction guarantee, you shouldn't buy it. I would never offer a product without this. So 100% guaranteed. The futures course, some of you might wonder what we're learning. What are futures, order flow, volume profiles, trading zone, intermarket relationships. I'll give you a few screenshots of what you'll see. Some charts that aren't time charts. These are money maker charts, I call them. How to read quotes, how to read markets, how to quote markets, how to find activity on the DOM, how to find sellers, icebergs, whole bunch of stuff. Intermarket relationships, which markets to correlate with, how to trade correlation. Today we had a $900 day in 18 minutes using correlation. You got to pay attention to it. All right, identifying trading zones, how to use them the proper way. You'll see these are broken down in different colors because there's different sessions you have to follow. Most people don't even know about a different session. How to find rejection levels, how to read order flow, how to get paid, how to find stuck buyers who are about to puke in stop losses, which is what happened here. Buying, 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 can't get it to go. Stop run to the downside. Clean them out. How to find transactions from the robots, the battle of the bots. Whole pile of stuff, guys. Of course, reading order flow, jam-packed with resources, imbalance reversals. I mean, this is different than what you're probably used to. Okay, the foundations course is more beginner-based. So I wanted to finish on this. The foundations course is where you start if you don't know where to start. All right, it's 24 lessons. It's beginner to intermediate level. Teaches you technical analysis. You have a 100-page workbook, journal templates, applied sessions, and we have a conditioning system that's built for you. All right, then we have an options course. We got a debit spread trading course, weekly analysis component on the option side. On the day trader side, it's a trading room, live analysis. Every morning we trade together as a group. Both packages for $139. Get in there and get that midnight bonus. It's a free coaching session. I usually charge for one-on-one time specifically because it's tough for me to get one-on-one time, right? After trading hours, I want to enjoy my life. During trading hours, I want to trade. So I'm going to throw that in there. Get it before midnight. Somebody asked, how do I get it? Donna, could you share the link through the chat? Go on the chat mode. Heck, you know what? Maybe I could do it too. See you, Phil. See you tomorrow at 9 a.m.